Damos inicio entonces a la primera sesión de nuestro Congreso, la que lleva por título Panorama Económico Global y los cambios en la industria financiera. Para hablar de este tema tendremos la participación de dos importantes conferencistas internacionales. El primero que se dirigirá a ustedes es el doctor Josh Wright, economista estadounidense de Bloomberg, graduado de Artes de la Universidad de Yale y con maestría en Política Pública de la Escuela de Gobierno John F. Kennedy de la Universidad de Harvard. Ha sido analista para el Banco de la Reserva Federal de Nueva York. Se desempeñó como oficial de prensa para las Naciones Unidas en Kosovo y Afganistán. Nuestro conferencista hablará sobre el dilema en el mundo post-crisis y sobre cómo lograr un crecimiento sostenido en este escenario. Temas que cobran relevancia debido a que la recuperación económica global no termina de consolidarse y las herramientas con las que cuentan los gobiernos para impulsar sus economías son cada vez menos. La exposición explicará los riesgos que existen en cada región y que evitarían consolidar una senda de crecimiento sostenible y la posición de Latinoamérica en este entorno global. Vamos a recibir al Dr. Wright. Bienvenido, adelante.
In one of the emerging markets we talk so much about now, and that we in the United States and some of the other major economies look to for the new frontiers of growth. So in that spirit, my comments today are going to start by talking about the outlook for the United States and the Federal Reserve and its monetary policy, since there continues to be a great deal of focus on what the outlook is for U.S. monetary policy. And then towards the second half of the talk, I will switch towards talking a little bit about longer-term issues and deeper factors that are driving both U.S. and global growth. And I have quite a lot of information on these slides, but it was impressed upon me by the translators that it is important not to speak too quickly. So I will try to slow this down, and I may skip over some of this as we go along. But without further ado, we're going to start with a familiar pattern that we have seen. So this graph shows you what the forecasts have been for U.S. growth over the last couple of years. And as you can see, they've all followed a pretty similar pattern, all in the same direction. There is this, over and over again at the beginning of the year or before a year starts, we've found that people have been expecting the growth would be about 3%. And then over the years, each time it seems to fall a little bit short. And this chart only shows you the predictions for 2011 through 2014. But actually, if you recall, even back in the spring of 2009, when the U.S. was still just finishing its recession, there were talks of green shoots and how the U.S. economy would have a V-shaped recovery and a very sharp rebound. And I think part of that has to do with, to put this in context, this 3% level that people expect. We're now down to just over 2%. That compares to an average in the U.S. between 1950 and 2007 of about 3.5% growth. So people have been expecting us to bounce back towards that historical precedent, and still a little bit lower than that, and yet we're not even making it there. And I think one of the things that's really interesting about what's going on in the U.S. economy these days is why is that taking place? And that's what we'll talk about in more of the second half of the talk. In the near term, first I'm going to give you a little bit of teaser of some of the things that we'll talk about. We will talk about the U.S. yield curve and what that tells us about the business cycle. We'll talk a little bit about these longer-term patterns in U.S. growth. And then we're also going to talk about this, what's been going on in the U.S. labor market, which continues to be so central for the U.S. economy and, of course, for the U.S. Fed. More and more we are talking about labor market slack and how the conditions in the labor market will affect the Fed's decision for when and how it will raise rates. In the near term, looks like this is might not be as visible to all of you out there, so I'll walk you through it. First of all, this is something I took directly from the Bloomberg terminal, and a lot of the information, almost all the information that I will show you today can be found directly on the terminal, including the charts that I will be showing you. This is one screen. If you're familiar with Bloomberg, you can enter the command ECFC, and it will take you to this screen. You can pick the country you want to observe, and here you see a suite of some of the most important economic variables, GDP, measures of inflation, unemployment, the current account balance. But I want to draw your attention to expectations for interest rates. So the central bank rate, or in the US, that is actually what we call the federal funds rate, as I'm sure many of you are familiar. It was above 4% before the financial crisis. It's been held in a range between 0 and 0.25% ever since. And expectations by a survey of economists, the survey is conducted by Bloomberg, is for that rate to be 1% at the end of next year. And one of the things that's interesting about that number is that it diverges a little bit from the FOMC or the committee at the Fed, their own projections, which are for a little bit over 1%. And we'll talk about that in just a second. Okay, so the big question really is, these days for the Fed is when and how they will raise rates. And there are a couple of questions bundled up in there, or there are two major aspects of that. Of course, there's the question of timing, which we'll get to in a bit. But here I want to highlight for you that there are major questions about what it will look like after the Fed begins raising rates. So many people expect that the Fed will actually raise rates very slowly. And once it begins, it will only be very gradually. Or there's also the possibility that the Fed will raise rates and then hold them at just a slightly higher level before beginning to raise them further. If so, and that is consistent with what the Fed has, some comments that have come out from Fed Chair Janet Yellen and other Fed policymakers, but if that happens, that would be very different from historical precedent. Because if you look at this, most of the times that the Fed has been raising rates, it has been at a very steady and relatively sharp angle. Not always the case when you had spikes in inflation. For instance, in the late 70s and early 80s, there were some rather rapid rises in policy rates. And so it's certainly true that now we are in a different kind of environment from the early 80s. Still, it raises the question of whether or not the Fed will be able to raise rates slowly. And I think that this is something that Janet Yellen has been very concerned about and was talking about just a few weeks ago at the famous Jackson Hole conference in the US. So I mentioned before that I showed you some projections made by private economists surveyed by Bloomberg, and I told you that they diverged from the projections that were provided by the Fed staff and Fed policymakers themselves. So here I just want to quickly walk you through what some of those projections are. Every quarter, the Fed releases a statement of economic projections, famously called the dot plot. Although there are projections of a variety of variables in there, GDP and unemployment, but the most famous part is this dot plot, which is where the individual members of the FOMC provide their own forecasts for where monetary policy rates in the US will be at the end of different years. So at the end of last year, there were some people in the Fed who expected that rates would actually be raised by the end of this year, which no one really expects anymore. And the expectation was at the end of 2015, median was about 0.75%. At the end of 2016, just under 2%. And over the long term, it would eventually rise towards 4%. And then in March, everything moved up a little bit, except 2014 moved down. People started to expect 1% at the end of 2015, and just over 2% at the end of 2016, still 4% in the long term. And then June, which is the most recent set of numbers that we have, there's still one person who thinks that rates might rise at the end of this year, but most people don't. And now the expectation is just over 1% at the end of next year, and about 2.5% at the end of 2016. But then take a look at this. Suddenly we have this decline in the long-term rate. And so this is part of this question about where growth will be in the US, whether growth will be slower, inflation will be slower in the long term, and if that means that the Fed will have its own policy rates, and therefore the broad array of US interest rates will be lower over the long term. And that's a very complex and interesting debate that I wanted to highlight for you up front before we get into some of these questions of timing. I also want to highlight for you, at Bloomberg, we're always looking for new ways to build out tools to help you understand what's going on in the economy and what's going on in the markets. So this is something we have under development, which will allow you to compare very quickly what the dot plots were at specific dates and compare those to market rates and what the fixed income markets are telling you about expectations for US monetary policy. So this chart, I wanted to highlight another set of questions that are bundled in this issue of, or this question rather, of when and how the Fed will raise rates. This is taking us from the when really to the question of how. So as I'm sure you're familiar, the idea of an interest rate at the end of the day is that that's really supposed to be the price of money. And traditionally, the Fed has been able to conduct its operations with one set of tools and in the context of very low reserve balances. That's the orange line. So this is not the money that you and I use, but the base money that is held by banks and then spreads out through the system. And then very famously, the Fed has expanded its balance sheet and rapidly increased the monetary supply from a little bit under 1 trillion to almost 3 trillion at this point. And in that period, rates have been held very, very low. The question is, though, will it be easy for the Fed to raise rates in the context of so many more reserves? Because once you have a larger money supply, then normally you would think that that would affect how you calculate the actual price of that money, and that, of course, is the interest rate. And so no one knows for sure how many reserves must be removed or even can be removed by the tools that the Fed has developed. And some of the statements that we've had from the Fed in recent months have indicated I would say, a very high degree of confidence that they will be able to control this. And certainly they have conducted some very extensive testing. And I think those results have looked pretty encouraging so far. But the reality is that no one knows for sure what will happen until the Fed actually turns on the lights and tries to make the machine run. The Fed has, when you think about the Fed and its balance sheet, it's not like a normal balance sheet for a number of reasons, and I don't want to drag you through all those technical details, but it's important to recall that these bank reserves represent the liability side of the bank's balance sheet. And corresponding with that increase in bank reserves, the Fed has drastically increased the asset side of its balance sheet, and that's through purchases, very famously, of a wide variety of securities. So this chart shows you how the Fed's asset side has transformed over time. You can see this very significant transition. The black line is the overall total level. The gray line is treasuries. So originally it was mostly just a treasury balance sheet, and now they've increased to have some agency debt and agency MBS or mortgage-backed securities on their balance sheet. This spike you see here originally, which does not correspond to the increase in mortgage-backed securities, that represents the emergency lending that was taking place in 2007 and 2008 before the Fed moved into this new world of quantitative easing. And the latest information that we have from the Fed is that there's a desire to get back to a Treasury-only balance sheet and for it to be a smaller balance sheet, not to continue to have so many assets which correspond to such a large number of reserves. And eventually they want to bring it back down. But instead of bringing it back down quickly, which is originally what the Fed thought they would need to do, they're thinking that they will actually maintain an elevated level so that this line will actually probably hold steady for a while and then only over years later start to decline, which is quite a change from what the outlook was before. And that brings us to the Fed's exit strategy, which can be a pretty technical subject, and I don't want to bore you with too many of the details here, but it is important, I think, to be aware of what's going on and some of the terms that are going to be thrown at you in the coming months and possibly years. Because the Fed has been building these new facilities, as I mentioned. For those of you who followed the Fed closely during the financial crisis, there was a whole alphabet soup that the Fed rolled out of emergency lending facilities and new purchase programs. And as I showed you before, that corresponded to changes in the Fed's balance sheet. So now on the back end of that process, the Fed wants to change the size and the composition of its balance sheet in order to affect that interest rate, that price on money. And as it prepares to do so, it's had to build another set of alphabet soup facilities, which fortunately there are fewer of them, but it pays to know that they're out there and that no one knows exactly how much the Fed will use them. So there's interest on excess reserves, or IOER, and there's the term deposit facility. Both of these only go to banks. That's important to keep in mind. And then there's reverse repos, which is that's a different kind of operation that allows for a broader set of counterparties. Why is that important? It's important because I believe the Fed is quite uncomfortable working with a broad array of counterparties. It had to work very hard during the height of the financial crisis to roll out some of its lending facilities in order to get money out to the broader financial system. And there were a lot of legal hurdles because the Federal Reserve System is really very much designed for the mid-20th century U.S. financial system. And I know you're all here to talk about how the financial system has been changing. One of the interesting things that has occurred in the U.S. over the last 80 years or so, really concentrated in the last 50 years, has been a transition from bank-based lending to markets-based lending. And so the fact that the Fed had to innovate and create all these other facilities, that reflected the fact that the Fed no longer had the ability to affect as much of the financial system because the financial system had grown outside of the Fed's traditional mandate area. And so it had to create this workaround. And now on the back end of that process, it has to create another workaround. And because the Fed has been testing, particularly the reverse repos, a whole lot, we've seen a lot of information come out in the news. There have been a lot of commentaries by economists about the nature of these different facilities. And the largest part of the testing has been concentrated here. And there were a lot of people that thought that because of that, this would be one of the major areas of focus for the Fed when it comes time to reverse and start to drain reserves and shrink its balance sheet. But what we've learned recently is that actually the Fed is even more uncomfortable with broader counterparties than we realized, because in the details of the FOMC minutes, the minutes from the FOMC meetings, we've heard that the Fed really wants to focus on using the tools that it knows it can use with banks. And they don't say that that's because they're comfortable working with banks, but they do mention some things that show that they do actually have a preference for working with banks and that they're concerned about this growth of the financial system outside of the area where they have a legal mandate to have the largest impact. So we've had some of this information leaking out through minutes from a variety of FOMC meetings this year. Even back in January, I think there were signs that the FOMC wanted to get back to a more traditional kind of system. But especially in June and July, we've had more and more details coming out. And a lot of this is hearkening back to in June 2011 when the Fed first provided some information about what it expected to do when it was contracting or shrinking its balance sheet. And back then, it really came all at once. The Fed provided a great deal of information, and it said these are the official, explicit exit principles. And now what we've seen is actually more details getting leaked out. And so the Fed keeps saying that there's more to come, and yet they've already provided us a great deal of information. So I think that they're trying to leak this out so that people can adjust to this new information slowly. What have we learned? Some interesting things, such as I showed you the slide before where the rates used to be at 4.25%, and now it's been a range between 0 and 0.25%. And many people thought that the Fed would go back to targeting a specific level. But now we're learning that the Fed would, I think this is where we had the largest level of consensus, in fact. They said most participants believed that it would be best to go back to continue to target a range of different rates. And I think that reflects the fact that the Fed is uncomfortable with these high levels of balances, and although it's confident that it's built some new tools that will be effective, it's not so confident that it feels comfortable returning to a world of targeting just one specific rate level. We've also learned, very interestingly, before people thought that the Fed would try to shrink its balance sheet before raising rates, and now we've learned that, in fact, they're going to keep the balance sheet at a high level for a while before they begin raising rates. We talked a little bit about the different rates that they will be looking at. The balance sheet, they're not even going to actually sell assets. They're going to look for ways to borrow them, or rather to lend them out to people, and therefore to take money out of the system by putting the securities back out in the system. And then we expect that there will probably be a good level of more details that will be released in the September meeting, which will take place just next week. Perhaps there will be more that will come out in October, but I think that the Fed must be getting pretty close to finalizing its decisions. And certainly what we've heard from Fed policymakers in recent weeks and months is that they say they've made excellent progress in their discussions of these issues, and they look forward to providing more information. One of the things that will be interesting to keep track of as we go through this process is that because the Fed is changing its footprint in the short-term fixed income markets, there are some questions about how the Fed's operations will transmit from one market to another. So those of us who watch the Fed closely will have to bone up and make sure that we're aware about exactly how these different markets interact. So I just wanted to show you some of those different rates that you have to keep in perspective. Here's the traditional discount window rate that the Fed maintains. That's at 75 basis points versus their interest on excess reserves, which they have referred to as the main focus of what they'll continue to target. And then we have the Fed funds effective rate in the orange. That has been the traditional target of the Fed. And they've said they're really going to focus on this green line and this orange line. But as you can see, these other money markets are fluctuating around this orange line. And since we don't know exactly how these operations will actually affect these money markets, the question is, as the Fed raises the green level, the green line, and it starts to use these operations, where will the orange line go, and where will some of these other rates go? Will they move up in tandem with them or not? I think it's interesting to note in this context, the Fed actually surveys the expectations of its major counterparties on Wall Street and asks them, how much do you think we will actually be using these operations? And the latest information we have is not that much. They're looking at about 350, about $500 billion in total is the median expectation from these people on Wall Street. And that compares to a Fed balance sheet that, as I mentioned, has ballooned from less than $1 trillion to north of $3 trillion. So that's quite a lot that will be left over that is not expected to get tied up in these operations and will still be floating in the system. And that's why there are these big questions about whether or not the Fed will be able to raise rates exactly when and the way that it wants to. Okay, so that's a fair bit about the how. Now I want to start talking a little bit about the when the Fed would raise rates and why it would raise rates. As you are aware, since the Fed has brought rates down towards zero, but the U.S. economic growth hasn't been as much as people were hoping for. It has been providing extra stimulus through asset purchases. That's very famous. Everyone talks about that in the market because this is affecting specific asset prices. But the other major tool that the Fed has been using in this new environment is what they call forward guidance. So that's effectively talking down rates. And they've gone through a couple of different varieties of this over the years. And the most recent thing is that they switched from quantitative thresholds, where they had specific levels on the unemployment rate and the inflation rate, to what they call qualitative guidance, rather, where they talk about their subjective assessment of these economic variables and what's going on in the U.S. economy. And the operative language that has become really crucial in the FOMC statement is considerable time. The Fed is saying that it will not raise rates or it won't consider raising rates until some considerable time has passed after it has stopped conducting these asset purchases. And Janet Yellen mentioned that that might be 6 months, but then she retracted the statement. But it does give you some sense of what they were originally thinking about there. And more recently, they've started to make some signs. There have been signs that the Fed may change this language as soon as the September or October meetings. Much of this debate about when to raise rates comes down to an assessment of what's going on in the labor market, with the key issue being the concern that the unemployment rate is not as representative as it used to be of the overall conditions in the U.S. labor market. And that's what is meant to be encapsulated or captured by Janet Yellen using this term of labor market slack. And so she's pointed to a couple of different measures, and I'm going to walk you through the latest information on them here. But I think one of the key things in the big picture about this is that the unemployment rate, part of why it's not representative or as representative as it used to be, or why the Fed is concerned about it, is that there are some key assumptions that are baked into the unemployment rate. You take a look at the number of people who are considered to be in the U.S. labor force but not working. But the labor force has some funny definitions. You have to have looked for work with sufficient intensity over a specific time period. And if you haven't looked for a job in the last couple of months, then you aren't necessarily counted as unemployed. But you might still be someone who does want a job and who would come back in. And so therefore, you're not getting counted in the unemployment rate, but you count as this measure of labor slack. And so one of the things that Janet Yellen has highlighted is some of these measures, the key thing is that they don't bake in as many assumptions. They are really directly observed things, and that people report specifically, they say that they want a job, or they say that they found a job, or that there was a new job, or they left their job, which shows that they have confidence. And that's why some of these measures provide such useful additional information. Now, the focus, of course, is on the labor market, and that's precisely because the situation in inflation has remained so benign in the U.S. The Fed hasn't had to worry about inflation because, as you can see here, the orange line is the Fed's preferred measure of inflation, and that is still well below the Fed's objective of 2%. And most recently, it did rise in recent months, but it's still held to about 1.5%. There's another measure of inflation that is a little bit higher, but that's still below 2%. And then you take a look at market expectations, and those are the dotted lines here. This faint gray line is the five-year forward, so longer-term expectations for inflation. They're a little bit higher, but that's further off in the future. And in the meantime, expectations for inflation over even a 5-year horizon in the U.S., those are still below 2%. And that's one of the things that the Fed continues to refer to, that market expectations, well, actually that expectations as a whole for inflation remain well anchored. So that, combined with the fact that the actual inflation data has remained well below 2%, gives it confidence that inflation will be under control. And then the big question really is where inflation will go forward in the future. But for now, the Fed feels free to focus on the labor market. And where the labor market and inflation really intersect most obviously is in the question of wages and how U.S. workers are being paid. And this has been for a couple of months and will continue to be a key area of focus for the Fed. And as you can see, there hasn't been, in 2014, which is really just here, there hasn't been any strong trend. There has been a little bit of an uptick in the last couple of months. But we've already seen a couple of false dawns this year where people saw a tick up in the monthly data that, the year-over-year level, this is, by the way, year-over-year level data that we're looking at here, but we haven't seen a really strong trend establish itself that has made people, really confident that there's going to be persistent inflation in wages. Okay, so that's wages, and then I just want to give you a quick overview of some other key labor market variables in the U.S. Net job growth has been quite strong and pretty steady. We had a bad report last week, which really broke trend. But outside of that, if you compare relative to other years and cycles, coming out of this recession in the last couple of years, the jobs numbers in the U.S. have been remarkably steady. But what that has been driven by is a very dramatic and steady decline in job losses. And what we haven't seen is the same level of gross job growth. And that's one of the ways that we see this uneven progress in the U.S. labor market. Turning back towards this question of uninflation, I split up here the long-term uninflation in orange and short-term uninflation in blue. And what you can see is that short-term unemployment has declined back towards its long-term average, versus long-term unemployment remains elevated. And this is one of the key measures of slack that Janet Yellen has told us she is looking at. And it really gets at the heart of the debate here over whether or not there is labor market slack. So many people have been wondering if the job market in the U.S. has become bifurcated between some people who are very desirable as workers, and so if they lose a job, they can quickly find a new job. And then there are other people who have been out for a long time. Will they come back? How will they get paid? Will they affect wage pressures? And then, of course, will they go out and actually spend money in the meantime? Do they feel that their job is stable enough? And so that's been one of the key areas of discussion. Earlier in the year, people said that because short-term, maybe all we need to worry about is short-term unemployment and not worry about long-term unemployment, because maybe inflation is more closely related to short-term unemployment. But although short-term unemployment has declined this much, we haven't seen inflation take off, so that debate has started to subside, and people aren't as concerned about that. Another measure of labor market slack is you take a look at gross job growth, which I mentioned, and that has started to pick up. But in the same report, you can see there are some other measures that, although they're doing okay, they have not grown in the same way. And that's part of this unevenness that we refer to as labor market slack. The key measure here is in orange, the quits rate. Janet Yellen refers to this repeatedly as something that she cares about. the idea there is that you only quit your job if you feel confident that you're going to find another job. So it's a measure of confidence from U.S. Workers. And as you can see, that confidence is not keeping pace with other areas of the labor market. And then the key measures of labor market slack, the most important ones I wanted to point out for you. The black line here is long-term unemployment, which we already talked about. The gray bars are for headline unemployment, which has already declined past the Fed's former quantitative threshold. And then this orange line is one of the other key things to keep track of. That's part-time workers in the U.S. And so far, what we've seen as progressively the labor market continues to recover, we've seen some encouraging decline in long-term unemployment, certainly not as much as short-term unemployment. But what we haven't seen is a commensurate decline in part-time workers. So one of my concerns when I look at the U.S. labor market is, are these long-term workers, even long-term unemployed workers, even once they get a job, how good is that job? Because ultimately, we need people to get in full-time jobs that provide stable wages and that have actual wage growth and have real prospects to generate the kind of consumer confidence and the consumer spending that is going to drive growth. I recommend that if you are following the Fed closely, these are the two measures to look at the most. And by the way, I should point out that all these charts, almost all these charts that I've showed you so far, are created directly on the Bloomberg terminal. And if any of you are particularly interested in them, such as this one, which I always point out to people, I'm providing my contact information. You can feel free to email me. If you're a Bloomberg subscriber, I can share this chart directly with you. Okay, so that's enough about the outlook for the Fed in the near term. Now I want to turn to some of those longer-term issues. And to do that, I'm going to return to the staff economic projections that I mentioned earlier in the presentation. And I want to compare what the Fed said in its first set of projections back in November of 2011 with its most recent projections, which came out in June of this year. So take a look here at 1% level earlier. But in the longer run now, they've shifted down. Rather than 2.5 to 3%, they're talking more about less than 2.5, just above 2%. So that's a significantly lower level. And that is what has led to this new debate about what was really the nature of the U.S. recession. Was there permanent damage caused by it? And is there something that we've started to refer to as the new normal or the new neutral or secular stagnation? These are some terms that have been thrown about, all to describe this question about the long-term prospects for growth in the U.S. And so to provide a more graphical way of thinking about that, here you've got real potential GDP in the U.S. over time, and then potential in black, and then the actual in orange. And as you can see, we fell well below our potential in the financial crisis, and we still haven't made up that gap. We've started to close it a little bit, but we're not quite there. I mentioned how far below we are in growth relative to the longer-term average, but the key thing here is that this looks like a much worse recession than anything we've seen, with a minor exception in the early 80s, but really this is much worse than even that. And I think that it has caused some very interesting and troubling dislocations in the U.S. economy and also our political system, which present challenges for us going forward. So before I showed you growth over time, but now I want to show you specifically the average growth rates following recessions in the U.S. And this is kind of a rainbow spectrum here from yellow to blue to black. And what it shows is that the yellow and green recoveries following a recession, those are the earlier ones, so the middle and late 20th century. And those showed much higher rates. And then over time, as you move forward, going through this spectrum of colors towards blue and black, those are the later recoveries. And what you see that they're posting slower growth rates. So there does seem to be some kind of longer-term trend that is taking place here. And that's what feeds into this question of secular stagnation. There are a number of factors that you can point to. Larry Summers, famous economist from Harvard, and a veteran of both the Clinton and Obama administrations, has spoken a lot about this topic. And some of the issues that may be driving it are demographics, the fact that the U.S. population growth is slower than it used to be. There are technological shifts, so the U.S. no longer has as much of a manufacturing base. And there's a question of whether or not we have the right education system in place in order to get our workers ready for the 21st century and the jobs that are available in the U.S. economy. We've got declining investment in research and development as well as in capital expenditures, both by the U.S. government itself, and we'll talk a little bit about fiscal policy, and also by U.S. corporations. And because of that, we've got an aging capital stock. And there are reasons to believe that that should contribute to a lower and slower growth rate over time. Another way of looking at this is you can just summarizing the average rates for each of these recoveries as points. And on the right, I have GDP growth, and on the left, it's job growth itself. You can see that the trend is a little bit more pronounced in GDP, but on the job growth side, I would suggest that although those numbers aren't as stark, they're also a little bit less telling because they don't tell you anything about the composition of jobs. And what we are seeing in the U.S. is a shift towards more part-time work. We take a look at the nature of the contracts between U.S. employers and U.S. employees, and there's less and less loyalty on both sides. So these are less stable jobs, and of course we've also famously, there's a lot of talk about how U.S. wage growth has slowed down, and so that I think actually makes this a little bit worse than it actually looks. Now there are some things that can be done about this. You could have more government spending on research and development or infrastructure and education. You could work on immigration policy so you can bring in, effectively increase your population growth that way. Certainly, everyone knows that there are issues in the U.S. tax system and that its entitlement system needs to be reformed. But the prospects, of course, don't look very encouraging for that to be addressed, any of those issues to be addressed in a big way over the next 2 years. Turning towards a more global perspective, I wanted to give you a more visual and direct demonstration of what's going on in demographic trends. So these are 3 countries that are interesting to compare, the US, China, and Japan. And as you can see, China had wonderful demographics as of 1990, and that has no doubt contributed to the excellent growth it has experienced since then. Now, of course, although China continues to grow at a rate that most countries in the world would envy, it has slowed down a little bit, and that is attributable in part to the fact that its demographics have started to shift. And as you can see, economists and demographers and sociologists sometimes say that China is in a race to get rich before it gets old. And they say that because you can see that by 2050, it will have a much less favorable demographic profile, where here you can see you've got a lot of prime age working people in China, and that is the largest portion of the population. So the more dependent people who can't contribute as much to growth, the older people and the younger people, they can rely on this nice fat middle. And over time, that fat middle is going to start moving up over the next 10 years. But by 2050, it's going to be weighted towards the top end. And so so the big question is, how much can China grow in that time between now and around 2030 or 2040? Because after that, it should slow down significantly. In the US, you can see that we've had, not as favorable as China had in 1990, and that corresponds, in fact, to our lower growth. And it's already become less attractive, but over time, it's actually going to hold pretty steady. And that has to do with the structure of our population right now. We have many young people, and also the fact that we just continue to enjoy, despite the problems that I mentioned in our immigration policy, there are still people that want to come to the US, and they come with their skills, and they come with young people, and they start their families, and that supports us maintaining a relatively attractive demographic profile. When you turn to Japan, it's an even more dramatic transition. As you can see, Japan has already moved from a relatively attractive profile to a relatively problematic one. And that's only going to get worse over time as they get more and more concentrated. And that is why so many people are concerned about the longer-term outlook for Japan. And so those are issues that many people knew, but I think they've started to take more seriously in the last couple of months. And part of what took that was prominent economists like Larry Summers talking about the issue. Although there are other economists who are famous, like Paul Krugman, who is raising concerns about the outlook for U.S. growth for a couple of years now. But I think that in addition, what we've seen in the U.S. economic data this year has made people pay a little bit more attention. Because although data have been relatively attractive in the second half of 2014, they really looked quite bad in the first half of 2014. And much of that has been attributed to weather, but many people have noted that it's hard to see such a strong contraction in the U.S. economy being attributed solely to weather. And moreover, it's pointed towards some weaknesses in the U.S. housing market. And a lot of people had been thinking that the U.S. housing market was going to finally have its recovery after this dramatic crisis that we had over the last couple of years. You had very strong price appreciation in 2013 and 2012. And in the second half of 2013, you still had quite strong price appreciation in the U.S. And that was after rates began to rise when Bernanke talked about stopping asset purchases for the first time. So I think there were a number of people in the market and among the economists who started to think that the U.S. housing market had made more progress than it actually had. And I think that they overestimated the level of recovery there. I think a lot of it was really driven by rates, and it was simply and a couple of other factors that are now starting to pass. And we're seeing that in reality, the U.S. housing market has some ways to go. I think stepping back from some of the details and some in the chart and on the bullets, Reinhardt and Rogoff at Harvard put out a very interesting paper recently where they talked about the average time it takes for an economy to recover from a very profound banking crisis. And they looked over many decades, and I think even centuries, and certainly over many different countries, and they found that the average was something around 8 years. So you think about the U.S. financial crisis really got going. You had a credit crunch in 2007. The broader financial crisis got going in 2008. But the housing market really started to turn around at the end of 2006 and early 2007. And here we are 7 to 8 years later. That's starting to look a lot like that Reinhardt and Rogoff average. Now, you could argue that the U.S. crisis was actually more profound than average, but you could also argue that the U.S. policy response, at least on the monetary side, has been stronger than average as well. So more or less, it's hard to predict these things. We're actually coming close to that average. So I personally am not as surprised as some other people to see that the housing market has faltered this year. I think that part of what was going on is not only the support from low interest rates, but also the fact that there were some government programs meant to remove some of the distressed inventory. So houses that had gone through foreclosure, people that weren't paying their mortgages anymore, those houses always sell for less. They go into disrepair, and they're usually in troubled neighborhoods. And now what happened is there were these programs that supported investors coming in and removing all of that problematic inventory. And so that led to quick gains because you took those out of the price indexes. But now that that effect has already been taken out, that's part of why housing price growth, although still positive in the U.S., has really declined quite a bit. But I think what it ultimately comes down to is the U.S. consumer. U.S. consumer spending is about 70% of our economy, 2/3 to 70%. So you've got to focus on the U.S. consumer. And one of the problems over the last couple of decades is that we haven't had strong wage growth. And without that wage growth, the U.S. consumer became more and more dependent upon credit in order to support his and her spending. And although some people have been pointing towards metrics such as this orange line, which is new foreclosures. So that measures when homes are being taken away. The process is initiated for homes to be taken away from borrowers who are not paying their mortgages. And they've also been paying attention to this other orange line, which is the mortgage debt service ratio. It's a ratio calculated by the Federal Reserve, which takes a look at your monthly payment for your mortgage. And so both of these have declined quite dramatically. And so there are a number of people, including at the Fed, who have said this is great. This means that the consumer balance sheet is over, the deleveraging process is pretty much done, and the U.S. consumer is back ready to spend. But if you take a look at some of these other measures, I think that we've got a more troubling outlook. Yes, we certainly see very strong progress. first let me explain what these are. The gray line is delinquencies and mortgages. So those are people who stop paying their mortgages. And the black line is the outstanding stock of foreclosures. So that's where someone became delinquent. That they transition from the gray line, they stop paying their mortgage, they move into the black line where there's a formal process for taking their property away. And what we see there is that we're only halfway done with that process. I guess a little bit past halfway at this point. And so that means that those are people who they're going to have a lot of damage to their credit score. That's going to stand on their credit score for about 7 years. So that's going to reduce their access to credit. That's going to reduce their demand for housing. It's going to reduce their ability to spend on all kinds of other things that U.S. consumers were using housing to support before. So that's one important thing that I think has been overlooked. And while I think it's important, I don't want to play Dr. Doom here. I don't want to tell you that the U.S. consumer is in terrible shape. I think the point is just that people got over-optimistic and thought that we've made a little bit more progress than we have. I think in the next 18 to 24 months, we should see this black line return back towards more normal levels. And and that will support consumer spending going forward. But there's still other reasons to be concerned about U.S. housing in the medium to long term, which we'll talk about in a second. The other thing I just want to explain here that I think is important is that it has to do with U.S. policy. There were decisions made during the financial crisis and in the years afterwards to focus the U.S. policy response in addressing the housing crisis on lowering homeowners' monthly payments. And that is certainly very important. You need that money every month in order to spend on other things. But at the end of the day, the total balance of your mortgage matters as well. And one thing that was not done is that no one reduced the size of some of these mortgages. And the reality is that some people are going to have to go through foreclosure, and some of this mortgage principal is going to have to be reduced outright. And since we still have a lot of people who are delinquent, that process has not been completed, and that's represented in the black line. So although people are paying less on a month-by-month basis, the reality is that a lot of U.S. consumers still have a large debt overhang. And even if your monthly payment has been reduced, if you have a large mortgage outstanding, it's going to be hard for you to go out and buy another house or spend on cars or education or many of the other things that drive the U.S. economy and many other economies that depend upon the U.S. Okay, just looking at the time. So this is a little bit more information about what's going on in the U.S. Consumer balance sheet. Don't want to drag you through too many of the details. But one thing I wanted to point out is that actually consumers are spending more on other forms of consumer credit. And some of that is good. Going out and spending on autos certainly helps because the auto manufacturing industry is very large in the U.S. But some of this gray line that has risen, this is the same black line I showed you on the previous page, some of this gray line represents the increase in student loans and the fact that U.S. homeowners are not able to fund education through their homes anymore, and because they don't have, or as much as they did before, and they don't have the same wage growth to support their children's education. That means that more and more education is being supported by debt. That's a problem because that's going to prevent some of these young people from going out and forming households and buying houses. And that's part of why I think that we've got a slower growth in the housing market than many people had expected before. And this is just another way of looking at what's going on with mortgages versus other forms of consumer credit in the U.S. Okay, so enough about the U.S. Now I want to talk just briefly about some of the other major economies and major trading partners of the U.S. because all that talk about the Fed is certainly domestically oriented, and the consumer balance sheet is really talking about that 70% of the U.S. economy that is consumption. But what about external demand? What you see here is we're going to talk briefly about Europe, Japan, and China, is not a whole lot of support from some of these other major economies. Europe and Japan, as I'm sure you're aware, face a number of important challenges that we'll walk through here. And although China continues to grow well, it's not growing quite as much as it did before, and it's going to face some medium-term challenges. So what's going on in Europe? Well, if you've been looking at the headlines recently, then I'm sure you're aware that the situation there has become troubled enough that the head of the European Central Bank has been announcing more and more measures. And in addition to that, he gave a speech a couple of weeks ago where he said, it's not just about monetary policy, we really need help from other authorities throughout European governments. And so that is effectively a cry for help, the way I see it. And I think that makes sense when you think about what the ECB has announced and what it plans to do and the challenges that face its programs. First of all, this chart is showing you euro area inflation. It's well below target. The headline number is just above zero, raising the very alarming prospect of potential deflation in Europe, seeing how Japan has suffered through deflation and struggled with coming out of that over the last couple of decades. There are good reasons to be concerned about that. And certainly that's one reason why the US Federal Reserve has been so proactive in the last couple of years, is because they have been concerned about US inflation falling down towards that zero bound. And then over here, you take a look at just general growth. The orange line is euro area growth, and these dotted lines are two of the key business surveys that come out of Germany. They're very strongly correlated with growth. They're leading indicators, and they have continued to decline, suggesting that euro area growth is not set to take off either. So the ECB has announced a form of quantitative easing focused on private markets, asset-backed securities, and there are questions about whether or not the ECB will undertake purchases of sovereign debt as the US has. But there are a number of reasons to think that this might not have as much of an effect in Europe as it did in the US. For one thing, I mentioned earlier about this long-term transition in the US economy from a bank-based financial system towards a market-based financial system. More and more deposits in the US are held by mutual funds rather than by banks. That transition didn't occur to the same degree in Europe, so it's still much more of a bank-based system. So the idea of going out and buying assets from banks that probably is not going to have as much of an effect in Europe, for the simple reason that European countries rely more on funding from banks themselves rather than from these asset-backed security markets as US corporations do. And what we've seen is that the European Central Bank has already undertaken purchases of covered bonds, and it has lowered rates into negative territory, and it still hasn't been able to take the euro area out of this downward spiral. And that's effectively why Mario Draghi was asking for other European policymakers to find ways to support growth. And of course, the big problem in Europe is that they don't have any unified way of changing their fiscal policy all at once. And so there are real challenges there for providing support from the official sector. In Japan, there's been this recent attempt to have a much more proactive policy in coordinating between the monetary and the fiscal sides. And the monetary side has been quite proactive, but it's not clear that the fiscal side is going to be as effective. So there are 3 arrows that Abe announced as part of his economic program. The second and third arrows were based on fiscal stimulus and structural reform. And he hasn't had nearly as much progress there as many people had hoped for. On the monetary side, there's been a very aggressive response, but some of the effects appear to be fading already. The inflation has really been driven so far. There's been an attempt to drive up inflation in Japan, but that's been driven by yen depreciation and tax increases, and the effects of those are already starting to fade. And in the meantime, household purchasing power has been eroded by that inflation. And then you turn to China, and this is a very complex story. There's a lot going on in China. I won't attempt to do justice to it here, except to say that I don't think a hard landing is likely. There are a lot of concerns that coming out of the financial crisis, China provided a very large stimulus, very proactive fiscal policy, but it led to a credit bubble. And now this bubble is going to have to decline over time. But I think the signs are that the authorities have a great deal of resources and a great deal of political will to manage that process effectively. So I think we're going to see more of a soft landing there. Although in the meantime, in the medium and long term, we're going to see that China has a lot of reforms that it needs to undertake, and therefore that is going to present a drag on growth, and we won't see it return back to those higher levels that we saw in the last 10 or 15 years. In just the last couple of minutes, I do want to point out that political risk has become more and more important. I think the events of this year and the last couple of years, but particularly this year, have been really striking in showing what's going on abroad. We've already mentioned monetary policy. In the US, of course, we've still got issues with fiscal policy and what's going to happen in the budget debates, which will resume in the beginning of next year. But I think in 2014, what we've seen is that geopolitical tensions are not what they used to be. And this has probably contributed to the steadiness of U.S. long-term interest rates. And it's a very interesting time in international affairs as you see Russia and China jockeying for position in the international order, and you see a breakdown in peace and order in the Middle East. And all those things are contributing to geopolitical risk, which will affect economic growth over time, and certainly confidence. Financial conditions, of course, remain easy thanks to support from central banks. And that has led to some concerns about a bubble in the U.S. stock market. Doesn't appear to be an outright bubble, but there is an interesting debate going on about where valuations should be. And the Fed, of course, took an interesting step just 2 months ago when it started talking about the levels in the stock market, which it hasn't done before. But now that it has a new mandate under the financial reforms in the U.S. to look at financial stability, we can expect the Fed not to say a lot more than this, but I think that they will be focused on this issue. They'll be asked about it, and they will occasionally make reference to that. And if they see things get too far out of balance, then that could actually affect monetary policy in the U.S. And then finally, I just want to talk about the yield curve, because traditionally it is a strong predictor of the business cycle. And what you can see in this year is that long-term rates have declined pretty significantly and quite surprisingly in the context of everyone expecting the Fed to begin raising rates. So after the taper tantrum, the long-term interest rates started to stabilize, and they've actually come down. And many people have been scratching their heads over if that is reflecting geopolitical risk, or it reflects the fact that the ECB has been easing, and it has been broadcasting for a long time that it would be easing, and therefore that provides an outflow of capital from Europe into the U.S. But although the yield curve has flattened a little bit in 2014, it's important in historical perspective to note that the yield curve has remained quite steep in a longer historical perspective. It's really much steeper than we've seen outside of perhaps 2 periods, but even steeper than then over the last 20 years. And if you extend this further back, the yield curve has rarely been this steep. But what we learned from the last turn in the interest rate cycle in the U.S. is that once it does turn, it could turn relatively quickly. And what we have seen this year is with that flattening in the long end, the beginning of the takeoff in shorter term rates. So this could be the beginning of that turn that might occur in the next year or two. So time is now up, and I will open the floor to questions. Are we taking questions? Yes? Okay.